Equity markets were strong during the first quarter, with global equities ending up 11.5% in Australian dollar terms. The listed infrastructure sector slightly outperformed broader markets over the quarter, with the FTSE Global Core Infrastructure 50/50 Index finishing up 12.1% in Australian dollar terms and up 12.7% in Australian dollar hedge terms. From a macroeconomic perspective, it was noteworthy to see the significant compression in bond yields across most developed markets. Following dovish commentary from both the US Federal Reserve and the ECB, long bond yields fell almost universally. The Australian 10-year yield fell to a record low of 1.72% during the March quarter. During such strong markets, our strategy would more typically lag broader market indices, considering our focus on defensive assets that exhibit lower cash flow volatility. Pleasingly, this was not the case during the March quarter, with our performance boosted by strong stock selection during the period. The fund was also up 12.1% for the quarter, in line with the reference index. It was a particularly noteworthy quarter for the fund in absolute terms, with 29 out of 31 holdings up over the 3 months. Within the portfolio, our North American pipelines were very strong. We had noted that this sector had become especially cheap in recent quarters and so had increased our positions within the fund. Stocks such as Kinder Morgan and Williams Companies both ended up more than 30% as the growth outlook had continued to improve. Notwithstanding the strong first quarter performance, we continue to see attractive investment opportunities in North American pipelines, underpinned by still attractive valuations, strong cash flow generation, and meaningful growth outlooks. Other US-listed portfolio holdings, including utilities and communication towers, were also stronger, supported by a continued flattening in the interest rate curve. Our US tower holdings, Crown Castle and SBA Communications, up 19% and 23% respectively, have continued to benefit from near-term growth expectations stemming from new spectrum deployment and the rollout of new 5G technology by mobile network operator customers, only just beginning. Channel tunnel infrastructure owner Getlink was also strong, up 15%, as the market's outlook for Brexit softened, traffic volumes continued to grow, and the market began to focus on the potential for corporate activity, given the recent changes in shareholders, with 2 large industrial companies now on the register. We recently conducted a site visit with Getlink management to the UK and French terminals on either side of the tunnel, and were particularly impressed by the Brexit-related works which are now in place in the event of a no-deal Brexit outcome. Whilst a no-deal Brexit is not our base case expectation, if this risk were to eventuate, the company is well prepared for electronic processing of freight through the tunnel and appears to be competitively positioned against the alternative of using ferry operators across the other major UK freight corridors. We continue to invest the fund in core infrastructure assets that possess high barriers to entry and strong strategic positions. These assets are mostly either regulated, subject to long-term contracts, or have been granted long-dated concessions. After a strong quarterly performance, we now see the sector valuation as being fair to slightly cheap, but with a number of attractive individual stock opportunities that we aim to benefit from.